My name is Aditi Nayar and I'm ICRA's Chief Economist and Head of Research and Outreach. Today, I have with me Mr. Prashant Vasisht, who's a co-group head in our corporate sector ratings, with me to discuss the expectations from the Union budget for FY 24-25, which is to be presented very shortly. On the macro side, our broad expectations are that a revenue upside is giving a cushion to Government of India to increase its expenditure or moderately pare taxes, perhaps on the direct tax side, or hasten the fiscal consolidation below the level that we were expecting in the interim budget. That is, bring the fiscal deficit lower than the original target of 5.1% of GDP that had been penciled into the interim budget for FY25. Now, we're going to today discuss with Mr. Vashisht some of our expectations for the oil and gas industry. So, Prashant, I'm going to start with what is your expectation of the budgetary allocation to compensate losses incurred by the OMCs on the sale of auto fuels and other sensitive products?
Thanks, Aditi. The oil marketing companies expect an adequate budgetary provision to compensate for any losses incurred on the sale of auto fuels and sensitive products, that is LPG and kerosene. Given the low under recoveries, the budgetary provision is expected to be low at about rupees 1,500 to 3,000 crores. However, in case crude oil prices rise, the subsidy incurred by the OMCs could also rise. Nevertheless, low provisions could pose a risk for PSU OMCs, in case prices rise, as I mentioned. And additionally, the GOI is expected to continue providing subsidies for the Ujjwala scheme beneficiaries also. So from the government point of view, the bigger risk is from lower dividends rather than higher subsidies.
Got it. And what are your expectations in terms of the special additional excise duty levied on the production of crude oil? What is the industry expecting?
So the government had imposed special additional excise duty on crude oil and certain refinery products with effect from July 1, 2022. Although it has revised SAED multiple times, these taxes have pared the profitability of upstream companies as well as the refiners. And accordingly, the industry has been demanding that the SAED be discontinued. Currently, the SAED on crude oil stands at about rupees 7,000 per ton of crude oil production, which translates to about $12 per barrel. And could lead to an annual contribution of rupees 18,000 to 20,000 crores to the government in FY 2025. As of now, there is no SAED on refined products.
Do you think that the government is going to announce any disinvestment intention for any of the oil and gas companies in this budget?
So the large ticket disinvestment like BPCL looks unlikely, and the government has already stated that. But the GOI may follow a more calibrated approach of selling a small part of its stake in some of the oil PSUs at best, is what we expect.
What are the other key pre-budget expectations of the oil and gas industry?
So owing to the active management of production and supplies by OPEC Plus, the international crude oil prices have remained elevated and are currently at about $83 per barrel. At high crude oil prices, the ad valorem cess of 20% limits the realization and cash accruals for the upstream companies compared to the earlier fixed cess per metric ton. So the upstream industry has been demanding a downward revision in cess on crude oil production to improve its earnings in a high crude oil price regime. The upstream oil and gas industry is also characterized by high capex requirements owing to the natural decline exhibited by oil and gas fields, due to which regular capex must be undertaken to sustain and increase production. Accordingly, one of the key demands of the upstream industry has been the exemption of exploration and production and development activities from the levy of GST, as the latter has the impact of bloating the capex. Additionally, the industry wants a levy of GST removed from petroleum, profit petroleum, and royalty, as these are not payments against any service and should not be subject to GST. So the incidence of GST has an adverse impact on project profitability and returns and discourages incremental investments. So this is again a key demand from the upstream industry.
Thank you, Prashant, and thank you, listeners, for tuning in to our podcast today.
Thank you.